All right, deep divers, welcome back. You ready to gear up for another deep dive?
Always.
Today we're going deep into the November 2024 FOMC meeting minutes.
Oh, yeah, these are always interesting.
Seriously,
Yeah.
the Fed can really keep us on our toes.
Right. What are they going to do next?
That's exactly what we're here to figure out.
Unpack these minutes and see what they tell us about where the U.S. economy might be headed.
And what it could mean for, us regular folks.
Exactly. Our wallets, our jobs, the whole nine yards.
Buckle up because we've got some interesting findings to dive into.
Like, did you see the Fed just cut interest rates again?
I know. Second cut in a row brings the target range for the federal funds rate down to 4.5 to 4.75%.
Makes you wonder, is that good news or are they worried about something?
Good question. Plus, they're continuing to reduce their holdings of Treasury securities and agency debt and agency mortgage-backed securities.
Lots to unpack there.
Definitely.
Yeah.
And then there's the talk about inflation cooling down.
Well, it has eased up quite a bit from its peak.
True, but core inflation is still kind of sticky, isn't it?
Yeah, the 12-month change in the PCE price index was 2.1% in September, but core PCE was 2.7%.
So businesses are still passing on price increases, huh?
Seems like it, although the minutes mentioned some businesses are hesitant to keep raising prices.
Why is that?
Apparently, consumers are getting more price sensitive.
Ah, so we're getting smarter with their shopping.
Maybe. It'll be interesting to see if that has a real impact on inflation.
For sure. Now let's talk about the labor market.
Still looking pretty strong on the surface.
Yeah, we saw decent job gains in October. Unemployment rate is around 4.1%.
But job growth has moderated a bit.
Right. Partly due to those strikes and hurricanes we saw.
Plus, the minutes suggest that businesses are getting more picky about who they hire.
And job seekers are maybe a little more willing to accept offers that aren't their top choice.
Definitely seems like a shift in the power dynamic.
Okay, now for the topic that always seems to make everyone nervous.
You talking about financial vulnerabilities?
The one and only. What are these vulnerabilities anyway?
Basically, think of them as cracks in the foundation of the economy.
Cracks. So, they're not causing problems right now, but they could.
Exactly. They could make things worse if we hit any bumps in the road.
Like what kind of bumps?
Well, the FOMC minutes point to a few areas of concern.
Such as?
Well, one that's been making headlines is those sky-high asset valuations, especially in housing.
Oh yeah, home prices have gone crazy.
People are starting to worry that they're not sustainable.
You mean like a housing bubble?
It's definitely a concern. What if interest rates keep going up or the economy weakens?
Sounds like that could lead to a painful correction.
And that could have a domino effect on the rest of the economy.
So it's not just about homeowners losing money on their houses.
Not at all. It could impact construction jobs, consumer spending, the whole shebang.
I see what you mean about those vulnerabilities amplifying any shocks.
Exactly. They can turn a little bump into a major earthquake.
Okay, so we've got those elevated asset valuations. Anything else to worry about?
Well, the minutes also mentioned the risks associated with banks holding large amounts of long-duration assets.
Like long-term bonds and stuff.
Yep, those are super sensitive to changes in interest rates.
So if rates were to suddenly jump up,
The value of those assets could plummet, and that could really hurt the banks.
and if the banks are hurting,
They might not be as willing to lend money.
which should make it harder for businesses to grow and for people to get loans.
Exactly. It could create a ripple effect throughout the entire economy.
And then on top of that, we've got the whole leverage issue in the Treasury securities market and the growth of private credit.
Right. Remember we talked about leverage being like a house of cards?
Yeah, one wrong move and the whole thing could come crashing down.
Precisely. Too much leverage in certain parts of the financial system makes us vulnerable.
So we've got these vulnerabilities lurking beneath the surface, even though the economy looks pretty good right now.
It's a complex situation for sure.
Well, this has definitely given me a lot to think about.
Me too.
We'll be back in a moment to break down what all of this means for us and what we can do to navigate these uncertain times.
Stay tuned. All right, so before the break, we were talking about those financial vulnerabilities, remember?
Yeah, those cracks in the foundation.
Right, and one of the big ones we're seeing is in the housing market.
Yeah, it seems like everyone's talking about a potential housing bubble these days.
It's definitely a concern. Those prices have been rising so rapidly.
But what would a housing market correction actually look like for, everyday people?
Well, imagine you bought a house a year ago, maybe even stretched your budget a bit to get in.
Okay, I'm following.
And then suddenly prices start to drop.
Oh, no.
Your home equity shrinks. Maybe you can't refinance your mortgage anymore, or you can't tap into that equity for like renovations or whatever.
That would be a huge bummer, especially if you were counting on that equity for, future plans.
Absolutely. And in a worst case scenario, some homeowners could even end up owing more on their mortgage than their house is worth.
Oof, that sounds like a nightmare.
It's what happened to a lot of people during the 2008 crisis.
Yeah, that's not a situation anyone wants to be in.
Not at all. And it's not just about individual homeowners either.
Right. A housing market crash could have ripple effects throughout the whole economy.
Exactly. Think about it. Construction slows down, people lose their jobs, consumer spending takes a hit.
It's all connected.
It really is. And speaking of interconnectedness, let's talk about those long-duration assets that banks are holding.
Those are the ones that are sensitive to interest rate changes, right?
Right, like long-term bonds and stuff.
What happens if interest rates were to spike suddenly?
Well, the value of those assets could plummet pretty quickly.
And that would hurt the banks.
It could definitely put a strain on their balance sheets.
And if banks aren't doing well,
They might not be as willing to lend money.
which would make it harder for businesses to get loans and for people to buy houses and cars.
Exactly. It could trigger a credit crunch.
Yikes. This is starting to sound a little scary.
Well, it's definitely something to be aware of. And then we've also got the whole leverage issue, remember?
Yeah, that's like the house of cards.
Right. Too much leverage in certain parts of the financial system can make us vulnerable to shocks.
So what could cause that house of cards to collapse?
It could be a lot of things, really. A sudden shift in investor sentiment, an unexpected economic shock, or even just the realization that some of those investments were riskier than people thought.
So it's like a lot of things are kind of hanging in the balance right now.
In a way, yes, but it's not all doom and gloom.
Okay, so what can we do to protect ourselves?
Well, the first step is to be aware of the risks.
Knowledge is power, right?
Exactly. The more you understand about what's going on, the better decisions you can make.
So like if you're thinking about buying a house right now,
Maybe don't stretch your budget too thin. Be prepared for the possibility that prices could go down.
and what about people who already own homes?
It's always a good idea to review your mortgage terms. Maybe see if refinancing makes sense.
Good point. And what about investments? What should we be doing there?
Diversification is key. Don't put all your eggs in one basket.
Spread the risk around.
Exactly. Invest in a mix of stocks, bonds, real estate, maybe even some alternative investments like precious metals.
So we're building a well-rounded portfolio.
Exactly. And don't forget about your emergency fund.
Ah, yes, the financial safety net.
It's so important to have some cash set aside for unexpected expenses or, if you lose your job or something.
Aim for 3 to 6 months worth of living expenses, right?
That's a good rule of thumb, or even more if your income is less stable.
Okay, so we need to be informed, diversified, and have a financial cushion.
Those are the basics, but there's also the psychological side of things to consider.
Oh yeah, it's easy to get caught up in all the negative headlines and start freaking out.
Right, but remember, the media tends to focus on the extremes.
So don't panic just because you see a scary headline.
Exactly. Take a deep breath, do your research, and focus on what you can control.
Solid advice. So we've talked about the potential risks and some strategies for mitigating them. But I think it's also important to remember that economic cycles are a natural part of life.
They are. We go through ups and downs. It's inevitable.
And by understanding these cycles and being prepared, we can weather the storms and come out stronger on the other side.
Absolutely.
What are the key takeaways you want our listeners to remember?
Well, I think the biggest one is that the economic outlook is still pretty uncertain.
Yeah, we're seeing some good signs, but there are also some potential risks out there.
It's like we're sailing through a fog bank,
You can see bits and pieces, but the full picture is still kind of blurry.
Exactly. We don't know for sure what's going to happen next.
So we need to be prepared for anything.
And that brings us to another important takeaway. The Fed is walking a tightrope right now.
Trying to keep the economy growing while also keeping inflation under control.
And let's not forget about those financial vulnerabilities we talked about.
Right. They're keeping a close eye on all of that.
It's a tough job they've got.
For sure.
Yeah.
So to our listeners out there, we encourage you to keep learning, keep exploring, and keep asking questions.
The more you understand about the economy, the better equipped you'll be to navigate the challenges and opportunities that lie ahead.
And if you enjoyed this deep dive, be sure to subscribe to our channel and hit that bell icon so you don't miss any future episodes.
We've got some great stuff coming up.
Until next time, stay curious and keep diving deep.